Good evening. It's July 11th, 2022. My name is Ted Whitehead, and I'm the Portfolio Manager of the Exemplar Growth and Income Fund. And I'd like to take this time to give you a recap of the first half of 2022 and our outlook for the back half. The Exemplar Growth and Income Fund is a balanced fund, and our process is to risk manage the business cycle. And we do that by using 5 different asset classes. 1 being cash, 2 currencies, 3 commodities, 4 bonds, and 5 equities. So let's get started. Back in October of 2021, the Fed announced that they were going to start shrinking their bond purchases. And this is really the beginning of the market decline as we've known it in the first half of this year. The Fed found religion and believed that they started to attack inflation. That didn't happen until the early part of 2022. But they did decide to start with trimming back bond purchases. So let's go through the charts and I'll show you everything that occurred in the front half and our outlook for the back half. So here we're going to start with the Goldman Sachs US Financial Conditions Index, and you can see it bottomed just around November of last year. And since that point in time has been increasing. So that's a tightening of financial conditions. And we're currently starting to get up to near 100. And it was when we went through that 100 level back in 2018, December 2018, the market took a spill. And again, in March of 2020, it went through 100 and the market again went into panic mode. And as you've seen in our weeklies, what we're really looking for at the bottom in the equity market is to see the VIX go above 40. And I think it's going to take this index going through 100 before we see that happen. So if we flip to the next chart, you can see the Fed started raising rates in March. Initially, they thought to start slow, and they did 25 basis points. And then in May, they did 50. And then in June, they found inflation was really not slowing down. So they did a jumbo rate of 75. And the last time 75 basis points was used at a Fed meeting was 1994. So it's really out of the ordinary. And they're going to do another one at the end of July. So they're ramping up rates very quickly to try and tame inflation. And all this is really having an impact on the liquidity, as we showed you at the beginning. So on the next slide, we show the bond market's been helping the Fed. It started the year at around 150 basis points and reached around 350 mid-June, and it's come off, and now we're sitting around 3%. It could be that this 350 ends up being the high. Maybe we don't break that, but it's too early to tell. So we're monitoring that situation, right? Inflation is still going up. We haven't seen a break in that, although our view is that this week's CPI is likely to be the high, or it could indicate that we've already started to roll over. On the currency front, you can see that 130 is really a very, I guess, neutral level for the Canadian dollar versus US. And we think it's likely to break out here. And we see the Canadian dollar go to 135, so essentially get weaker. And this is probably due to the fact that oil has probably seen its peak in this run. So again, the US dollar is what people go to as a flight to safety. And if we're expecting sort of an event to occur, you'll likely see the US dollar get stronger versus the Canadian dollar some point in the next 6 months. On the equity front, you can see this is the S&P. It peaked, I think it was January 4th. and has been in decline again with the bond yields going up and the Fed fund rates going up. The Fed is actually getting what it wants from the equity market, which it wants to see a negative wealth effect, which will help contain inflation. If everyone feels poor, they'll want to spend less money. We don't think it's totally done yet. I would say somewhere in this range, 3,400 to maybe 2,950, probably closer to the 3,500 range, but we still see more pain to come in the US equity market. If we go on to gold, the lack of liquidity or the liquidity coming out of the system has finally started to impact gold. It was around flat on the year up till the end of June, but has now started to come off. And it looks like 1684, 1680 is probably where it might find a bottom. But if things get really out of hand, maybe it drops below 1400. But that's not our base case, more or less 1680. And then you could see a ramp back up in the gold price. Looking at the Russell 2000, again, going back to when the Fed said we're going to start reducing our bond purchases, that's when the Russell peaked. And so it's been in decline since November. Same can be said for the NASDAQ. It's been in decline. And lastly, it can be said for Bitcoin. It peaked in November and has been in decline. So what does all this tell you? I think it comes down to the Fed drives the bus. It's all about liquidity. If you take liquidity out of the market, all asset classes tend to get affected negatively. And essentially, since the announcement of bond purchases being reduced, and then you had the bond market yields start to rise in the early part of the year, in towards all the way to June, and you had the Fed start to raise rates in March and continue and still on a rate hike path. And this is all to bring down inflation. They believe they can get inflation back down to 2%, or at least that's their goal. And I would say that's not very likely. I would say the market is likely to break before they can get Fed funds rates much higher than 3.5%. We're already seeing things break, whether it's with the currencies like the euro nearing par with the US dollar, or whether it's the housing market. You're starting to see cancellations on purchases. The mortgage rates have doubled from a year ago. So there is a lot of pain out there and a lot of dislocation. And with that, I think you're likely to see something break where the Fed is forced to stop or pause rate hikes and maybe even pivot and start to lower rates. But that's not something we can predict as of happening tomorrow. It's something that may happen in the future. So I guess now it's time to take a look as to what we think things can do going forward. And I think we have a possibility to make between 3 and 5% in the back half of the year. And basically it's in the US dollar. We think we can make 4 to 5% in the US dollar. In the bond market, yields may come down to maybe the 250 level, and we could make 3 or 4% in bonds. Equity markets, depending on how things play out, we could get a drawdown and then a bounce. So maybe down 10% first, then up 10%. And if we can play the up, maybe we can make some returns there. And lastly, on the gold, if it holds this level at 1684, maybe there's a 10% bounce in gold. So overall, I think in the back half, I'm a little more optimistic that there will be other asset classes that participate to the upside. But I guess key to that will be the market forecasting the Fed to pause or pivot, or the Fed actually does pause or pivot. And then other asset classes will be able to produce a positive return or begin going up on that change. So to summarize, our outlook for the back half is a little more optimistic. And on that note, I will sign off, and we will keep in touch in the weekly and do another podcast in September. Thank you very much.